You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, maggots, drop and give me 20. It's time for Options Bootcamp. And I promise that is the first and last time you will hear me say anything like a drill instructor on this program. And of course, you're listening here to Options Bootcamp. This is the program where we take in the raw retail investor and we break you down and rebuild you into a seasoned options veteran. My name is Mark Longo. Many of you may know me from a little site called theoptionsinsider.com that has a lot of options education, information, analysis, unusual activity alerts, and breaking news from the options market, as well as host the Options Insider Radio Network, where many of you may be familiar with my voice from those other programs that we do on the old network. But I am not alone here on the old Options Bootcamp. I won't be your only drill instructor for this program. No, not by a long shot. I am also joined here, whistle in hand, by one Dan Passarelli. He is the founder of Market Taker Mentoring, and he's also the author of several seminal options tomes, including Trading Options Greeks and the recent Market Taker's Edge. Dan, glad to have you on the show, sir.
At ease, soldier. Great to be here.
Is your whistle ready, sir, for all the basic training we have yet to come?
Oh, I'm having the new recruits polish it for me.
There you go. See, you're getting in the spirit already. And Dan, as we are wont to do here on the old Options Insider Radio Network, since this is your first appearance here on the network, why don't you give our listeners a brief overview of your background in the options biz, as we like to say?
Certainly. Well, I started in the options business a long time ago, back in May of 1993. Had just graduated college, printed up a stack of resumes, put on my best and incidentally worst suit. It was the only suit I had at the time, and knocked on every single door of the Chicago Board of Trade building, got myself a job as a runner, and learned the ropes down there on the trading floor. After a few years of learning the ropes from the best minds in the business, it's the center of the universe for option trading right there in Chicago at one of the exchanges. I became a market maker myself and enjoyed a pretty long career as a market maker down in the pits on the CBOE and the Board of Trade. And then in 2005, the CBO asked me to come and teach classes for them. And I kind of got the bug. I kind of enjoyed the feeling of giving back to the trading community after many years of being a trader, and decided to branch out and do it myself. And now here I am with Market Taker, And I'm offering classes to people and giving presentations and doing radio shows like this and writing books and just really, really enjoying my new role in the business.
It is a fun bug to catch. I do have to say so myself. But, I think it's a good point you make, and it's one we should definitely bring up to the listeners here. We joke here about the boot camp and the drill instructor nature of this program, all the training that is involved. But truth be told, both you and I started on the SIBO floor back in 1997. I'm not a local. I didn't go hat in hand around to the exchanges. I actually was recruited out of school from back on the East Coast, where there really, 97 were very few derivatives trading jobs, and I got lured onto the belly of the beast down at the SIBO. And both you and I had the luxury of being trained full-time by professional market-making, liquidity-providing firms for a year or over in some cases. This was our full-time job to learn options trading and to become functional options traders and risk managers. And that's something that I think a lot of newcomers to the options space tend to overlook, that you're diving into the weeds there with a lot of pros and seasoned experts who have been trading options for a long time. If you want to be successful in implementing these instruments, you really need to devote some time to training and to learning your craft and to honing your craft. And so that is really what we're attempting to do on this show, is try to encapsulate all of the various things that Dan and I learned the hard way down on the floor of the CBOE and all of our various ventures since, and present that to you in a format that you can then take and incorporate into your own trading to make you a much better options trader. And so with that said, let's dive into our inaugural basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, pull in, prepare to learn.
All right, and welcome to Basic Training. This is the portion of the program where Dan and I slowly break you down and break you of your bad habits as retail equity traders and rebuild you into seasoned options veterans. And because this is our inaugural program, we're going to start things off with somewhat of a 10,000-foot view. A lot of people come to us on the Options Insider and on the radio network, and I'm sure you, Dan, over at Market Taker and all of your various webinars and seminars that you give over there, and they come to us with the question, why options? Why should I use these products? And that question comes from a variety of demographics. It could be basic retail. It could be the financial advisor who's been long only in equities for a long time and is thinking about getting into options, or maybe a hedge fund manager who's maybe not that sophisticated when it comes to options. A lot of different audiences are coming to us with this question. So it seems like a good time to answer that and kind of make, in general, the case for options. So, Dan, you want to run with that, or shall I start, sir?
Yeah, I think I can take this one. If I had a nickel for every time that somebody came to me with some sort of prejudged, I guess, concept of what option trading is all about and why they should or shouldn't get into it. And, to the same point of why people maybe should think about options, there's a whole bunch of people who get into options for the wrong reason because they have like crazy expectations about how they're going to get rich tomorrow. And so
and that's partially to blame for the options education industry, and particularly the paid education industry that's sprung up over the past 10, 15 years, and some of the shadier elements therein that have utilized that approach to enrich themselves and bankrupt their customers over and over again. That old, I always joke, that old late night infomercial pitch of the make money in any market environment using options. How many times was that one around back in the day? That old straddle scam that was huge for a long time.
Yeah, the problem is there's plenty of people who get into my end of the business, the education end of the business, for the wrong reasons. Guys who never traded options professionally before. They just figure, hey, I know how to sell stuff. Traders have money. I'm going to teach people how to trade. And then they go read a book on how to trade, and then they teach you what they just read. Yeah,
unfortunately, there's a lot of that floating around out there.
Yeah, there sure is. But, back to the original question, why options? Many of you are maybe thinking about getting started in options. You see that this is an options education radio show. Thought maybe you'd tune in and try it out, kind of dip your toe in the water. And you might be thinking, hey, why should I be thinking about getting into options? I watch the news and I hear people tell me, oh, derivatives, and options are derivatives. Derivatives, they're causing all this trouble. They're, cause the mortgage crisis. They caused, this and that. We should outlaw derivatives. We should have all these laws against them. There's all this, backlash against derivatives because the media demonizes
That's
them.
why I tend to avoid the D word whenever possible. It's become too loaded. It's too pejorative now. Whenever you start the conversation with the D word, it just only goes downhill.
It really does. But the problem is it just comes from a misunderstanding. I mean, people throughout all of history always fear the things they don't understand. I've got a good friend in this business, and he's described options as fire. You can use it to heat your house, or you can use it to burn it down. And options are like that. And I'll tell you what, if you don't go out there and get yourself some education, you're probably going to burn your house down. But for those of you who put in the time and learn them, they are hands down the best and most accessible risk management tool that a regular Joe has.
I think that's important to accentuate as well then, is of course there is that general derivatives misperception that they are all dangerous, and that falls to options as well. Options are nothing but risk additive components to your portfolio, when the truth is, when they're used properly, 99.9% of the time, they are risk mitigating, risk reducing elements of your portfolio. You incorporate options to reduce your overall risk in your portfolio, and yet that, for whatever reason, that message has not permeated out through the financial media and the general media and out to the investing public. So it's left to specialized outlets like us to try to reshape the way people think of these products, because quite frankly, they're not the liquid nitrogen or the the TNT that people think they are, where it's going to blow up in your face 99% of the time. They really are risk reducing. And you're correct, Dan. If you do use them improperly, like anything, it could be devastating and it could burn your house down. But hopefully we'll teach you not to do that on this show.
Exactly. I mean, they are a fantastic tool. They should be taught in every university and possibly in every high school in the nation. Options are the one way where anybody can go in there and they can protect assets and keep themselves safer. The way that they're designed now, and the changes that have happened in this industry over the last, maybe 12 years or so, have made them completely accessible to everybody. Anybody who has a trading account, if you have an online account that enables you to trade options via your computer, you can use options to protect yourself. Options are veritable insurance policies. That's what they can be used for, and that's what plenty of people do use them for. Individuals like people listening to this show, and also professionals who manage billions of dollars. Nice conservative plays, again, if you know what you're doing.
That's true. They have become far more accessible over the past decade or so. Of course, like we mentioned, when you and I got into this business, really the only way in the mid-90s or so was to go down to the floor. If you really wanted to become serious on options, to go down to the floor and learn it the hard way in the belly of the beast. And now, if you wanted to execute anything substantial, you had to execute it through the floor, through open outcry, on the phone with a broker. It was a laborious, tedious, slow, and dangerous process. You can get hung on or have a bad fill. It was just not very retail or individual friendly, and that has completely flipped the other way over the past decade. I mean, firms like our partners on this program here, Zecco, are really bringing to the forefront a lot of accessible options technology that was, quite frankly, the realm of the pros when you and I first started, Dan. I mean, I remember when I first walked onto the trading floor with a electronic handheld that allowed me to update my Greeks on the fly. The people thought it was voodoo. They thought, "What are you doing? You're not using sheets? What sort of wizard
big
are
brick
you?"
That weighed like 5 pounds.
It was about 10 pounds.
You wore around your neck like an albatross.
You had to have something to actually hang it from your neck, and I got lucky. I actually attached mine to a power terminal to make it easier to stand there for 6-7 hours a day holding it. But yeah, that was voodoo. And now it's kind of funny to think a little over a decade or so later, all of that now is given for free to all the retail traders out there just for opening an account. It's amazing to think that they can get their Greeks, their all the things that we're going to discuss on this program accessible quickly, easily, and completely for free. That's just an amazing thing. If you had told me that when I first got into this business, I never would have believed you in a million years.
Well, there used to be lots of barriers to entry. I mean, it used to be in the old days, I mean, you'd have to call your broker on the telephone when you wanted to make a trade. You'd have to wait till he answers. You'd tell him what the order is. Then he'd hang up with you. He'd call down onto the trading floor, talk to the phone clerk. The phone clerk would fill out an order ticket, send it to a runner who would walk to the pit, hand it to the broker, would call it out.
Runner was a bit of a misnomer in that one, wasn't it?
Yes, exactly. You get in trouble for running on the trading floor, but they're called runners. And, I mean, a trade could take 10 minutes back then. I mean, the price could move wildly. If you weren't down on the trading floor, you were at a huge disadvantage. And flow of information back then was limited. Your analytics were limited. Typical traders didn't have access to Greeks and things like that. To get access to a pricing model would have cost you $1 million. Only the big trading firms could do that. And then, of course, commissions for a round turn for an option trade back in the day. I remember even when I was trading on the floor, when I traded in my retail account, I'd pay $30-$40 to buy a couple of calls every once in a while. You know, now we have firms like Zecco where the commissions are just so minuscule. Actually, the commissions in many cases right now in a typical retail account are lower than what I was paying down on the trading floor when I started.
Yeah, you know, that's true. I've actually seen an interesting trend of, you know, some of the guys that you and I both still know who are still out there persisting in the market making community to this day, despite all the reasons to abandon that. But some of those guys are migrating away from professional accounts. I just had a chat with someone the other day talking about looking at some of the retail firms to migrate his market making and his prop trading to. And just if you're going to trade primarily positions anyway, and the margin treatment is almost as favorable, if not preferable in some scenarios, to what you're getting as a market maker, the tools are definitely better. You'd be amazed at how little you get from a prop trading shop these days in terms of tools and functionality. You get access to data, you get a deal, you get leverage, and that's about it. Everything else is on your own. So I'm not surprised to see a lot of these guys starting to migrate to some of these retail accounts that are essentially quasi-professional in a lot of ways, which is, I think, a very interesting development for us. And I know, of course, you and I have been waxing nostalgic here about the good old days of options for a while here. I think it's time we dove into exactly what the heck it is we're talking about here, which is, of course, what is an option? If you're coming to us as the proverbial raw recruit just coming to options for the first time, you may be wondering that exact question. And the textbook definition of options, the one that was beaten into our heads over and over again down the trading floor, Dan, was, of course, options are the right but not the obligation to buy or sell a particular underlying at a particular price by a particular date. And there's a couple of things in that definition I think are worth calling your attention to. But the first one I like to start off with usually is that time element at the end there, by a particular date, because that is usually what throws off newcomers to the options market when they first come to options. Is they're used to trading stocks, and they're used to, you know, what's the old adage? If you buy a stock and it moves against you, oh, now it's a long-term hold, right, Dan?
Yeah.
Now I have a long-term view on stock X that's down 50% on me. You can't take that same point of view in options. Options expire. So you can trade a stock and you can hold a share of stock, let's say IBM, infinitely, as long as you like in your account. The stock will never go away. It won't expire. Whereas an option, it has a finite lifespan. It has several months or several years or whatever the case may be. And that is usually the first stumbling block. And one of the first concepts I really like to introduce to new options traders is that when you're coming to options, you have to be prepared to not only be correct in your estimation of the movement of the underlying or volatility, whatever the case may be, but you also have to be correct within the right time frame. If you're thinking X stock is going to go up and you buy a call option on it, but the stock may go up, but it may go up 6 months from now, and you bought a 1 month option that has already expired, so therefore you were not correct. So there is that element that I think is a stumbling block to people when they first come to options. Is that something you see as well in your work, Dan?
Yes, there is. I mean, when people invest in or trade in stocks, they're fairly straightforward. They're what I call linear assets. Stock goes up, I make money. Stock goes down, I lose money. Anybody can figure that out. And don't get me wrong, to do the analysis and all that kind of stuff, there's a whole bunch more to it. But as far as how the asset moves, it's up or down. Options are different. Options have more components than just the up or down, and that's what trips a lot of new people into options. That's what trips them up. There's a time component to them, which is naturally inherent because of, like you're saying, Mark, the expiration date. There's also a volatility component. There may or may not be an interest and dividend component. So they're a lot more multifaceted, and it serves traders well to understand how each of these nuances affects an individual option play.
Exactly. And those are, of course, the Greeks, which you have written about extensively, have literally written the book on, Dan. So we'll get into those quite soon, because I know you're champing at the bit there to dive into those Greeks. But I think we'll dial it back one notch even further now that we've scared you about the time component, and talk about the two basic flavors of options. When you're coming to options for the first time, you're going to see essentially two varieties. You're going to see calls and puts. And what you have with a call option is essentially the right to buy a particular underlying at a particular price by a particular date. And now the put is the flip side of that. The put gives you the right to sell a particular underlying at a particular price by a particular date. And those two options, the calls and the puts, make up everything you see in this broad spectrum that has become the options universe that we know and love today. And so if you think about that on a purely fundamental level, let's start with the call, because I think the call is the easiest for most people to wrap their heads around. Buying an underlying makes a lot of sense. The right to sell a stock gets a little confusing to some people. But the right to buy the right to buy the underlying makes sense. So we'll stick with the buying a call. Why would you want to do this? Why would you want to come in and buy a call option, give you the ethereal right to buy a stock when you can just buy the stock itself? And there are a couple of different advantages that options pose. The first one that a lot of people migrate to, and is probably also the most dangerous for a lot of people, is leverage. And that is when people come to a particular underlying, they'll see XYZ stock is trading $100, let's say. And if I want to buy 100 shares of that, that's now $10,000 I have to put down in my trading account, or if I do it on margin, $5,000. That's a lot to outlay for a particular trade. Now, if I go out and if I can buy and create an approximate or equivalent position using options, if I can buy one or two options or let's say one option for $1 around that same strike price, or even $2, that's a much smaller outlay. You're only talking a few $100s versus $5,000 to $10,000 for that equivalent position. So that is immediately attractive to a lot of people who want to manage their capital and utilize it in the most efficient manner. It's also where some people get into trouble because they say, wow, I can buy so many of these because they're so cheap, and then they load up and swing for the fences.
Yeah, Mark, you're touching on something really important here. There's both a leverage and a safety component to options. So imagine you have $10,000 in your account and you want to buy 100 shares of $100 stock, but you really like this trade. You'd actually like to buy 200 shares, but you can't afford to. Now, you can't afford to go out and buy 200 shares outright, but you actually could buy the stock on margin. Margin means you can borrow up to 50% of the price of the stock. Now, a lot of traders that I know say, buying stock on margin, that's kind of risky. I could get a margin call. I could lose more than I have invested in the stock. I'd rather not do that. But you could buy two options that gives you the right to buy the stock for significantly less than half the value of the stock. 5 or 10% of the value of the stock, and that's all you can lose. So you can get both leverage and safety in a single option trade.
Yes, and that's as we like to talk about here on the show, the proper, the nuanced use of options for leverage, as opposed to the people who, like I said, who come in first-time options traders and like to swing for the fences. Oh, I can buy 10, I can buy 20 of these. Why not? And that's where, or worse, sell 10 or 20 of these, and that's where the leverage starts to become a wee bit of a dangerous thing. But some of the other benefits of utilizing options, we mentioned the leverage. They also, like Dan said, provide that safety component. The put option gives you the right to sell an underlying. That, of course, provides a guaranteed floor to a stock that you may hold. So you can imagine the benefits of that. If you're holding IBM stock and it's trading 100, or XYZ stock, you're trading 100, you have the guaranteed right to sell it at 95. If the stock drops below that, you're out at 95. So there is a value to that. There's a safety element to that. And that's where we get into the risk mitigating element of options. And the third and very popular use case for options is to generate income. And that's very intriguing to a lot of equity traders as well, because how often do you hear, Dan, someone coming to you saying, I really love this particular stock, but I really wish it paid a dividend, and I wish it had some of these other elements that I wanted. And then they learn that they can use options to create a dividend on any stock that they want. And it suddenly starts to open their minds to the many, many possibilities that are available to them through options.
Yeah, exactly. That's one of the underrated things that a lot of new people coming into options don't understand is you're right. It's not just leverage and it's not just safety. You can do things with a stock that are completely different than what you can do if you only trade the stock and don't trade options. You can trade, a stock that's in a range. Like I gave a presentation last night and I said, hey, one of the stocks that I trade options on quite often is Johnson & Johnson. And I said, I know what a lot of you guys are thinking. Johnson & Johnson, that's the most boring stock in the world. Hasn't this guy ever heard of Apple?
Don't get me started on the Apple of. That's a whole nother show, sir.
I know. But the case in point is Johnson & Johnson is about the most boring stock you could ever imagine. I fall asleep just looking at the chart sometimes. And the reason why I trade it is because I can make some pretty good leveraged profits on a really boring stock like that if and only if I know how to trade options.
All right, so let's look at some examples then of what we're talking about here and some of the use cases for options. I talked earlier about the calls and the puts and what that means and what the two flavors of options essentially that are out there. Let's look at an example of a call. Now, let's say you're an options newcomer, you're coming to this for the first time, and you're looking at everyone's favorite underlying XYZ stock.
Yeah, I love that stock.
And yeah, I've made and lost so much money on XYZ over the years. It's amazing. But XYZ stock is trading $100 right now. So you can go right now, if you want to buy 100 shares, it costs you $10,000, like we discussed before. Now, if you look on the options chains now, all of a sudden you're seeing a variety of different choices, a variety of different options, pun intended, for what you can do. And so to drill down even more then into what we're talking about here, we talked about calls and puts and those being the two main flavors of options. Dan alluded to what we call the Greeks, the variables that go into options pricing. I think we'll get into those on our next show because those are worthy of their own segment. I don't think we'll have time to do them justice here. We'll probably overview them, but I don't know if we have time to dive into all of the components. But one of the components that is critical to how an options work, particularly for what most of our listeners are interested in, which is equity and the majority of index options, is what is called the multiplier. An equity option, index options, they come with a multiplier. The multiplier for most equity and index options is 100. Now, what do I mean by that? That means essentially for every contract that you buy, every options contract that you purchase, every options contract that you sell, it is in effect, or it is the equivalent of 100 shares of that particular underlying. So let's look at an example here of the long call in everyone's favorite good old XYZ stock. XYZ stock, let's say, is trading for $100. Now, you can come in, as we discussed earlier, and buy 100 shares of that for $10,000, and you have the stock. If it goes up $1, you make $1. If it goes down $1, you lose $1. It's like Dan said, it's a very linear asset. Now, let's look into the options chain a little bit and look at some of the options quotes that are out there. And now, all of a sudden, let's say in our theoretical example here, we can buy a call option. Remember, the call gives you the right to buy the stock at a particular price by a particular time. We can buy a call option that expires in 1 month So we have a full 30 days for this option to work its magic, so to speak. And this call option we're looking at buying gives us the right to buy XYZ stock for the price of 105. And for that right, for that 30-day right, we will be charged $1. So now you might say $1. Oh, that's really cheap. Wow, I'll pay $1 for that. Sure. But then you realize that these options, these equity options, have a multiplier. That means you have to multiply that by the price to get the true cost of those options. And since this option contract is for 100 shares of stock, it's actually, for every one contract you buy, will cost $100, not $1. So instead of buying the $10,000 worth of stock, you could buy a position that will make money if the stock rallies beyond the 105 price for the price of $1. So you spend $100 to capture that ethereal right. And now, so let's look at a couple of scenarios of what might happen once you own this call option. The first is that the stock stays right at 100. And so, as you can imagine, let's say 30 days from now when the option expires, XYZ underlying XYZ stock is trading 100. That is a scenario where, as you can imagine, someone in the marketplace is not going to want to buy the stock for 105 when it is trading 100 and they could freely buy it in the market for $100. So as you can imagine, that call will expire worthless. It will have no value to you. So that $1 you paid, that $100 you paid, will go away, and that will be, you will have lost the value of that option. Now, the second scenario is if XYZ stock rallies to 110. Now, all of a sudden, the stock is $5 higher than where you were given the option to buy that stock. So now you look at the chart and you see you have, when the stock expires, you have the right to buy it at 105. So now, just if we do the math in our heads, the right to buy the stock $5 below where the stock is trading should have a value of $5. And of course, when the option expires, it will have that exact value of $5. So this option you paid $1 for is now worth $5. You can also look at it as your net profit is you paid $1 for that option. So essentially your net break-even price on that is 106. So you made $400 worth of profit on that position. So you can see just by that quick example some of the value of options. And I also should dive into another term we've been throwing around here a little bit too, which is, of course, the underlying. That is pretty straightforward, but that's a term that Dan and I use without even thinking about it because we've been doing it for so long. But that is, of course, the term for what the actual asset is that you're trading with that option, whether it is usually a stock, it can be an index, it can be a commodity, it can be a currency, it could be essentially whatever you want it to be. It could be lean hogs, it could be whatever you're interested in trading in. That is the underlying for that particular contract, that particular option. So, like I said, these are some of the terms that Dan and I will be using throughout the show, and we want to present them to you up front. Dan, anything you want to tack on there to that example?
Yeah, I just kind of like to pass on that we're spending a little bit of time here in this first episode going over some of the terms. And there's pretty good reason for that. The words that we use as option traders and as option teachers, those are like the number one problem why people get confused with options, in my opinion. People can kind of grasp some of these basic concepts reasonably easy, but once you throw all these fancy new words in there, it gets a whole lot more confusing. So, we're just trying to make these terms a little bit more accessible to you, and you're going to keep hearing them over and over and over again as you subscribe to this podcast and listen to the show on a regular basis. So hang in there and stick with us, and you'll go far, kid.
Yes, these terms are quite literally Greek to you because they are literally Greek variables. So that is often the case when people first come to options, that they are just overwhelmed by the literally a different language. They're throwing mathematical symbols at them, and that if you're coming to it new and fresh, that usually tends to blow people's minds, which is why we don't dive into the Greeks right off the bat. We give them a little bit of time to learn the basics first. We do a quick walkthrough. We are running a little bit long, but it's so much stuff to get to in these opening shows that we want to kind of just squeeze it all in. Maybe we'll do a quick long put example, and that may give you just the other side of the coin there. Dan, you want to run with that one, or shall I? I hate to monopolize all the examples here.
Yeah. Puts are the ones that can be kind of confusing, like Mark pointed out earlier. And it's because a lot of people approach trading from first having learned about investing. And as an investor, you learn, well, I buy an asset that I think will appreciate, and you kind of get that drilled into your head when you're 16 years old taking an economics course in high school. And once you decide to become a trader, and traders aren't investors, you're a speculator. You're trying to make money on some movement of assets in the market. And of course, you have a byproduct of that, which is providing liquidity, which is good for everyone. So speculators aren't evil. But your motivation
again,
is,
that's a whole nother show. That's another 2 hours of topic.
Totally do an hour on that one for sure. But as a trader, you're trying to make money on the market doing something. Now, there's plenty of traders out there who I know who first got started in this business who go through charts and they look for a chart that's going up, and they come across a chart and they see one that's going down. They look at it and they say, oh boy, it looks like this stock's going to zero. Oh, yuck. Well, I'm not going to trade that one. Let's find a different stock. Well, hold on a second. You can trade that when you're in the world of options. You can take a position on the expectations of a stock going lower. And what you would do is you would simply buy a put. You would buy the right to sell that stock at a fixed price. So imagine there's a stock that's trading around $55 a share. And you're studying the chart, and boy, it looks like the stock has broken through key levels. We'll kind of keep it pretty basic for right now and not start talking about fancy technical analysis terms and such. But it sure looks like the stock is going to zero fast, right? So what you can do is you can buy, say, the 50 strike put. Now, that gives you the right to sell the stock at $50 a share. And maybe you'll pay something like, let's say $2 to buy that put, which, again, as Mark pointed out, is actually $200 when we use the multiplier. Now, if we were to short this stock, we could have significant risk if we're wrong. If the stock goes significantly higher, boy, we could lose a whole bunch of money. But when we're buying puts, we can only lose what we've paid for the puts. If we buy one put, we have $200 at risk. All right. Now, the stock's at 55. We're buying the 50 strike put. Now, note that right now the stock is above our strike price. We have the right to sell it at 50, but we don't want to sell it at 50 right now. It's trading at 55. So we'll patiently wait. And if we're correct, our forecast comes to fruition and the stock does indeed falls below 50, say it falls to $40 or $45 a share, we could theoretically exercise our right to sell the stock at $50 a share. Now, a couple things here. One is we don't own the stock, so we'd be selling the stock short. Now, I've already made the case for saying you probably don't want a short stock that can be theoretically a fairly risky position. So what we can do in this case instead is we could instead sell the put itself for a profit. Because if the stock is trading at $40 or $45 a share and we own the right to sell stock at $50 a share, clearly that put has value. Someone will pay us for that. I mean, if we can sell stock $10 above where it's trading in the market, somebody will pay us at least $10 for that. That's what it's intrinsically worth. So we don't necessarily have to exercise our options. We can simply buy them at one price, and then as the market goes our way, we can sell them at a higher price and just simply take profits on the option itself. We're option traders. We're not stock traders using options to get into the stock. We're option traders.
Yeah, that's a great point, too, is the vast majority of options positions are not held until expiration. I know if you ever looked at any options education, you're seeing all of these options expiration graphs and what things are worth at expiration. And it's a good educational tool, but fundamentally, very few people actually hold their positions until that point. They usually sell or close them out long before then because, like Dan pointed out in his example, you don't want to deal with the ramifications of having to exercise this option, getting short stock, or whatever the case may be. There's costs and commissions and everything else involved in doing that. You have to dump excess capital into your account to cover the underlying and things like that, whereas if you can just sell the stock or sell the option and take the profits, it makes a heck of a lot more sense to do that and move on to the next trade. People think they have to hold these options to expiration when, quite frankly, that usually is not the case. All right, Dan, that's going to wrap it up for our inaugural basic training segment. I know there's so much more you and I both want to talk about, but we don't want to keep our listeners here for 5 hours on the opening segment. We want to get into the Greeks and everything like that. You wrote a whole book about the Greeks. That'll be coming up, I believe, in episode 2. We can really dive. You want to devote a whole segment to that. You don't want to just touch on those elements because they are so fundamental to options. But I think just to review the concepts that we covered on basic training for today, we started off with the literal options basics. What is a call? What is a put? Of course, the call is the right to buy the stock at a particular price by a particular time. The put is the inverse of that. It is the right to sell the stock at a particular price by a particular time. Of course, some of the reasons you would want to utilize options would, of course, be for insurance or defensive uses, as well as generating income, which we haven't had a chance to get to. That involves selling options. That will be another show down the road, as well as, of course, leverage. And then we got into some of the components of options, including the multiplier, and the vast majority of the options that most of our listeners will be dealing with will have a multiplier of 100. That means for every one contract, it will be for 100 shares of that stock or that index or whatever the case may be. So most of you should look at options prices when you're pricing them out. You see a price of $3 or $4, be sure to multiply that by the multiplier, which is, of course, usually 100. And then we got into a few examples of options and how they work, both the long call and the long put. And by saying long, we don't want to confuse you by thinking bullish. That is another thing that a lot of equity traders coming to options for the first time confuse or conflate on this. We mean by long, we mean just purchasing. So you're purchasing a call or you're purchasing a put for your trading account. And then we touched on the Greeks, of course, delta, gamma, theta, and vega, but we didn't really have a chance to get into those because those are Dan's bread and butter, and we'll be getting to those in the next episode. So that's a little bit of a tease for you out there, listeners, for episode 2 of Options Bootcamp. All right, and that is going to do it for our inaugural episode of Options Bootcamp. You can also surf on over to theoptionsinsider.com, where you can find the program there as well. And of course, you can always search for Options Bootcamp or Options Insider Radio in iTunes. And of course, I also want to thank my cohort, my partner in crime, my fellow drill instructor here at the old boot camp, none other than one Dan Passarelli. Dan, I'm very glad to have you on the show with me here today, Dan. This is going to be, I think, the start of a wonderful partnership going forward. I know our listeners will be much the better for it.
Indeed, yes. We're going to have some good times and some good radio shows coming up here. So stick around, guys.
Yes, I'm very excited. And before we go, Dan, of course, let our listeners know where they can find you if they want to learn more about your mentoring, as well as those books you have floating around out there they might want to check out.
Certainly, yeah. My website is markettaker.com. So market as in stock market, taker as in you take something, markettaker.com. And you can visit me there. You can contact me through my website there and get some free content. Have a whole bunch of really interesting stuff there to peruse. And you can check out my books, Trading Option Greeks and The Market Taker's Edge. You can take a look at those on Amazon or your local friendly neighborhood bookstore.
Do those still exist? Neighborhood bookstore. Wow.
I think there's one in Ohio somewhere.
There's one in Chicago. You have to go look for it. Yeah. All right. Thank you for that, Dan. And of course, we want to thank you, the listener out there, for joining us for this inaugural episode of Options Bootcamp. And we look forward to more time and more basic training with you and more drills to come in the very near future. So we'll see you back here for episode 2 of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.